So, zero hedge again. Imagine that. One bank's surprising discovery. The debt party is finally over. Really? Are we sure? As SpongeBob would say, are you sure, you're sure, you're sure, you're sure? A recurring theme on this website has been to periodically highlight the tremendous buildup in U.S. corporate debt. Most recently in April, when we showed that, they link it, corporate debt to EBITDA data hit, or to EBITDA, what I like to call it. Anyways, corporate debt to EBITDA hits all-time high. The relentless buildup is something which even the IMF recently noted when in April it released a special report on financial stability, according to which 20% of U.S. corporations were at risk of default should rates rise. Again, we're in June. Federal Reserve, you guys hiking or not hiking? You going to hike or not hike? Or are you going to take a hike? What they need to do, get the hell out of here, Fed. Take a hike. It is also the topic of the latest piece by Societe Generale's strategist Andrew Lapthorne, who uses even more colorful adjectives to describe what has happened since the financial crisis, noting that the debt buildup during this cycle has been incredible, particularly when compared to the stagnant progression of EBITDA. Lapthorne calculates that S&P 1500, I think he meant 500 or 500x financial net debt has risen by almost $2 trillion in 5 years, which is a 150% increase, by the way. But this is mild in comparison to the tripling of the debt pile in the Russell 2000 index in 6 years. He also notes, as shown, he previously has shown that as a result of the debt surge, interest payments cost the smallest 50% of stocks in the U.S. fully 30% of their EBIT, compared with just 10% of profits for the largest 10%, and states that clearly the sensitivity to higher interest rates is then going to be with the smallest 50%, while the dominance and financial strength of the largest 10% disguises this problem in the aggregate index measures. Another key point that he makes, as also highlighted here, as in Zero Hedge back in November 2015, is that the reason for this increase in debt is largely down to financial engineering, aka share buybacks. See the chart below, it says. And again, that's, we understand the markets are rigged, the Fed intervenes, etc. But believe it or not, there's a big hidden hand as well. Besides the Fed's hidden hand, there's a second hidden hand. And that's these big companies themselves. They got all this money, cheap money, borrowed at near zero. So they take that money and do stock buybacks, which pumps up their own stock. It's that simple. It's out there and they just buy it back. But what happens when interest rates rise? That debt becomes more hard to deal with. Bankruptcies start arising. All these companies that have no business, they even having a multi-billion-dollar worth, value in their stock, net worth or whatever. There's no way. Those things are going to have to go down. They're going to have to go down. And it may take the whole company down when this finally happens. But again, will they pull another rabbit out of their hat? Wouldn't be surprised. So anyways, another key point he makes is that back in November 15, they covered this, is that the reason for this increase in debt is largely down to financial engineering, aka share or stock buybacks. See the charts below. However, the most recent data points to a significant change in this trend, with not only debt issuance in decline, but also the quantity of share buybacks. Clearly, over the long term, this is obviously good news. Borrowing money to buy back your elevated shares is clearly nonsense. However, that has been the case for a number of years now. Are U.S. corporates really waking up to the foolishness of their actions, or are they constrained by their balance sheets? Or they may simply be anticipating greater clarity on Trump's policies? Who knows? But in the short term, This does significantly reduce the impact of the biggest net purchaser of U.S. equities, according to the Societe Generale strategist. In other words, Lapthorne has found something surprising. After years of constant growth having boomed out of control, net debt growth is rapidly heading toward zero, and perhaps even a contraction for the first time since the financial crisis. Needless to say, for an economy in which debt growth, either public or private, has been a primary driver of overall economic expansion, this is a stunning development. So what is driving it? Here, Lapthorne makes several nuanced observations which have significant implications not only on future debt levels, but overall equity prices and broader risk assets. He says, firstly, while the headline S&P 500 continues to move higher, ever higher, the dynamics within the U.S. equity market are not so encouraging. I'm not going to show it right now, but the chart below breaks down the Financial Times, or FT, U.S. non-financial universe into top and bottom quintiles based on balance sheet strength as measured by Merton's distance to default. What is abundantly clear is that while the strongest continue to do very well ever since the Fed surprised the markets back in February with a U.S. rate move, stocks with the weakest balance sheets have struggled. This goes to an observation we made last month, namely that virtually half of the S&P return has been due to just a small handful of high-growth tech, i.e. no-debt companies. At the same time, the average stock, as measured by the equal-weighted performance, has also gone nowhere. And here is where Societe Generale may have found something few have considered so far. Quote, many are associating the surge in FANG, which is again Facebook, Amazon, Google, those guys. Many are associating the surge in FANG performance as a go for growth play, but in reality, it looks like investors are running scared into cash-rich companies. Lapthorne's conclusion, this is not a Trump policy play. This is a balance sheet risk. Lapthorne highlights an odd discrepancy between equity and debt. The aversion to debt may seem a little odd given that high-yield bonds or bond yields are down at historical lows and the appetite for new issuance remains strong. What drives credit is typically a mixture of leverage levels, interest rates, asset prices, and asset volatility. Corporate leverage ratios are currently high despite near-record asset prices. And while interest rates are gradually rising, credit spreads on high-yield bonds have plummeted. Why? Well, asset volatility is very low compared to historical levels, or to put it another way, asset price confidence is high. Thus, coupled with the continuous clamor for yield, or interest rate return, is helping to compress corporate bond spreads. This overconfidence may be misplaced. If equity volatility were to move higher, lower quality bonds could struggle as firms with poor balance sheets are already in the U.S. equity market. Going back to the core point made by him, and that is namely that investors are increasingly reluctant to lend to companies that already have a sizable debt load. Lapthorne points out, as one would expect, that where he has seen the greatest aversion to debt is within the smaller cap Russell 2000 index. A long/short balance sheet strength strategy is up 20% this year. The long leg is up 7% and the short leg is off 13%. To confirm this is not all about beta or cyclicality, a long portfolio formed on just price volatility is flat this year, while the short leg is off 7%. To summarize this unexpected finding, which started by looking at debt incurrence among various quality strata of companies and ended up with implications for risk appetite for stocks, the strength of tech stocks, lowest amount of debt, and the Russell 2000 weakness, the most debt, this year has nothing to do with Trump and everything to do with interest rate rises and balance sheet concerns. And since everybody's cooking their books, as I've mentioned to you and showed you numerous times, balance sheets are going to have a problem. They're going to be exposed as the problem. And not only that, it's June. To hike or not to hike, Fed? What are they going to do? Again, hiking will bring the problem closer and faster. Not hiking and actually reversing, we're going to take the interest rates back down a little bit. We'll actually stem it off a bit. I've said this before. The Fed is not supposed to make moves in advance. The Fed is supposed to look at certain things in the markets and different data and say, okay, this whole market here, this is too hot. We need to adjust the interest rates and cool that off, so to speak. Or the opposite occurs. Market's doing not too good, whatever particular market, whether it's housing or the stock market, whatever they're looking at, which again, you change interest rates, you're affecting all that stuff. And they may, one time they may need to raise it a little bit, they may need to lower it. Again, it all depends. Where do you want inflation? Where do you want this stuff? But they're supposed to make the decision based on this data beforehand. The data coming in, then make their decision. What the Fed is doing, essentially, is making their decision. We're going to raise rates no matter what. Well, this data look good. No, actually, it doesn't look good. It doesn't look good. Here's data that says it doesn't. Well, no, the economy still looks strong. We're going to go ahead with it. So they're bringing it on. They're bringing it on. That's what they're doing. So, quick look surprised. I mean, this is what they do. Everything that's happening and has happened financially, economically, ups, downs, business boom cycle, this is all a result of the Federal Reserve's policies. And again, the rich don't care because the rich get richer and the poor get poorer. And everything they do, one way or other, for some odd reason, benefits the 1%. For some reason, it just benefits them every time. But they're telling us they got to do it for all of us, to save us all. But it just so happens to benefit the rich and not you. Take care.